Hello, everyone, and welcome to our review of the statement of cash flows. Statement of cash flows. Think of the statement of cash flows as really putting it all together in terms of the combination of the income statement, which captures profitability, and the balance sheet, which captures firm liquidity through our holdings of assets, along with our uses of financing for those assets. Statement of cash flow will show you how much cash flow was actually generated by the firm throughout a given period of time. Remember, accrual accounting involves the use of the matching principle, which means that net income may or may not closely approximate the amount of cash flow coming into or out of the firm. So we need a statement of cash flow to actually show us how much cash flow was produced by the firm. All told, you want to think about it like this. If net cash flow, the aggregate level of cash flow produced by the company is positive, that's a good sign. That's good, that's healthy. If it's negative, that's more worrisome, because negative net cash flow is going to eat into our liquidity base, which is our cash holdings, and at some point we'll run out of cash. Okay, so net cash flow is the key variable in all this. And so net cash flow consists of the sum of cash flow from three activities. All right, you need to know these three activity types. Now, there's a lot more to the calculation of statement of cash flow than what we're going to get into here. Your book doesn't cover it either. In future graduate courses, you may do a little more discussion on these. I think certainly in corporate financial management you would. But for now, it's sufficient to be aware of these three categories: operating activities, investing activities, and financing activities. Operating activities are like the lifeblood of the firm. Primarily, this is the cash flow that comes into us through the income statement. Investing activities involves our holdings of assets. Remember, every asset on the balance sheet has to be financed. So for increasing assets, that's generally a cash outflow. Not a bad thing, because we need assets also to generate future revenues, earnings, and cash flows. But in the short term, the year or the 2 years or 5 years, whatever the case may be, in which we add to our asset base, is going to eat up cash flow. Financing activity is often used as sort of the plug figure, where companies will raise money to help offset cash flow deficiencies in other areas. Financing activities involves, if I issue a new bond or get a new loan from a bank, that's cash inflow to me. If I issue shares to the public, that's a cash inflow. So if I raise capital through those activities, I can help provide cash flow to help offset losses in operating activities, or cash flow that's being used for investing activities. If, however, I'm recapitalizing and I'm buying back shares or paying down debt, then financing activity cash flow may actually be negative. Net cash flow, once we've calculated it across those three components, and we'll do a basic calculation on the cash flow, it's then combined with the beginning of period cash holdings to calculate the period end cash holdings. All right. If you think about a balance sheet at the end of the most recent year, the cash holdings on it, it's the end of the previous year's cash holdings, but it's also the same thing as the beginning of this year's cash holdings. What's going to change those cash holdings to the next year's is simply net cash flow. And so if net cash flow is positive, cash holdings are going to build. If net cash flow is negative, cash holdings are going to shrink. And we know that cash holdings are an important indicator of firm liquidity. That is the ability of our firm to meet its financial obligations when they're due. So here are again your sections of the statement of cash flows. Operating activity captures your net income, and then adjustments are made. Those adjustments are important, and we won't get into the blood and guts of those, but you know from our discussion of income statements from earlier that net income includes some non-cash issues in it, namely depreciation and amortization. Those are not true cash outflows. They're subtracted from revenues, though, to get us a tax benefit. We have to add those back. But then also you've got the matching principle from accrual accounting that involves recording revenues when they're earned, not necessarily when cash flow comes in. We got to adjust for that. There are accounts receivable balance. We have to adjust for the fact that we've had cost of goods sold show up, and yet we actually haven't paid those bills yet. So we've got an accounts payable issue there as well. So operating cash flow through operating activity is often thought of as the lifeblood of the firm. And for young, growing companies, operating cash flow is very often negative. And that's understood. It's understood that young companies with great growth prospects may have negative operating cash flow for a while because they haven't reached scale yet. Investing activities involves changes in fixed assets and changes in any assets, frankly. As we grow, we need to invest more, right? We may need more property, plant, and equipment. We may need more inventory. We may need more cash and short-term investments. All those absorb cash flow. At the same time, companies that are in the maturity phase or the declining phase of the company growth cycle, they may be shrinking and selling off assets. So in that case, investing activity might actually generate cash flow. With financing activity, this reflects changes in sources and uses of capital, where capital refers to long-term financing, long-term debt, and equity. So when we issue stock, when we issue bonds, that all provides us with cash flow to help balance out deficiencies in either operating or investing activity. You could have positive cash flows in each of those three areas, or they could all be negative as well. It depends. You can have all sorts, every combination that's possible here. Bottom line, if the sum of those three is negative, that's negative net cash flow, that's going to take away cash holdings and liquidity from your company. Here's a very elementary examination of the statement of cash flow, not a full-on statement of cash flows where we break down individual components of operating cash flow, investing cash flow, and financing cash flow. But this is what I think is most pertinent for you to know in graduate business fundamentals. And that is to sum these up to get to net cash flow, number one, and then see how you combine those with cash equivalents at the beginning of the year to get to your next period cash position. So let's take a look at cash flow from operations, investing, and financing activities. So we look at those values in the first panel of the Excel sheet. Cash flow from operations was positive. It's a good number. We did a good job of turning revenues into operating cash flow, 929.10. However, for whatever reason, we also had to invest a lot in assets. And that's why we've got negative 496 there. That's showing us that we had to invest in assets to the amount of $496. That absorbs cash flow. In terms of financing activity, we didn't raise money there because it's not positive, it's negative, meaning we either paid down debt or repurchased shares or had dividends to pay to shareholders or some combination thereof. Bottom line, when you add up those three values, you get net cash flow of 232.48. By itself, that's a really good indicator. The beauty of seeing how net cash flow is broken down into those three components is you can see the source of, well, why was it positive? It was positive because cash flow from operations was so lucrative. Now, how do we take net cash flow and use it to see where we're going in terms of liquidity? Great question. Take your net cash flow and then add it to your cash holdings that existed at the beginning of the year. So if we had initial cash position of $600 at the beginning of the year, then by the end of the year, our cash and equivalents will have grown to $832.48. That's simply the sum of the two. So the higher is net cash flow, the higher will our liquidity be. And then you could trace back and see, well, how can I grow net cash flow, right? And just keep on walking that back to see how you come up with strategies to get that very thing done. So some key insights from the statement of cash flow. Number one, it indicates the areas that are absorbing and generating cash flow. That is so pertinent to the firm. That provides an indicator of sustainability. You know, if we're year over year, every year, we're producing just barely positive net cash flow, and it's always because we're raising cash flow from financing activities, but investing in operating cash flow are always negative. That's not sustainable. At some point, the credit and equity markets will no longer give us capital to fund that gap for us at some point. The maturity of industry and age of the firm are key drivers of this. Older firms and mature industries have positive cash flows from operations and financing activities. Younger firms, though, in less mature industries, usually what you see here are negative cash flows from operations, negative cash flows from investing activities as well, because they're investing a whole lot, but positive cash flows from financing activities. So in terms of the combination of whether you're positive operating cash flow and negatives on the others, it really depends on where you're at as a company and where your industry that you operate in is on the pure maturity growth cycle.